Hi everyone, Sean Humphreys here. Welcome to this edition of the Take Charge or Change podcast. In today's podcast, I'm going to talk about financial resilience, and specifically, I'm going to talk about an issue that retirees have had to be dealing with for really 30 plus years when they look at their retirement plans. And as I've looked back over my career over the last 30 years, it's been an ongoing issue. In fact, I think that this one issue is one of the most important planning points that individuals need to take into account when they're planning their retirement. So you'll enjoy this edition of the Take Charge or Change podcast if you're 5 years out from retirement, you're just on the runway, or if you're currently retired. Okay, talking about this one issue, and really the one issue can be summarized as declining interest rates. You know, typically when we think about retirement, we automatically default to wanting to be more conservative in our approach to investing. And that's understandable. As you get through your career and you don't have regular earned income anymore, you want to be more cautious because you just can't deal with the natural volatility of capital markets the way you used to. You just don't have as much time on your side. And that's often how people think about their retirement planning, is that they just have to be more conservative. In fact, one of the rules of thumb that we have talked about over the years in the industry is take 100 minus your age, and that will give you a bit of an idea as to how much money you should have allocated in your portfolio to growth or equity, kind of more risky kinds of investments as a way of trying to drive higher returns. So if I'm 60 years of age, 100 minus 60 is 40%. So a 60-year-old, using that rule of thumb, should only have 40% in the stock market or growth investments. Now, it's a very generalized kind of planning point, but I think it's a good way of leading into the discussion around building portfolios for retirement. Now, here's the real dilemma that we've been facing really for, like I said, 30 plus years. And if we go back to the interest rate cycle over the last number of years, and let's just go back to 1980. Yeah, it was one of the last spikes in interest rates. And some of you watching this video will remember those times when, mortgage rates were like 18%, interest rates were just skyrocketing. And it was a very, very difficult time for anyone that was, servicing a mortgage. Well, since that time, of course, interest rates have been going steadily down. So we've just seen this declining interest rate environment so that interest rates are basically rock bottom in 2016. Now, I'm the first to admit and agree that likely interest rates will start to incrementally go up, but I don't think it's going to be a fast incline. And so for retirees, over this last number of years, they've been in this situation where as interest rates have been declining, this rule of thumb is getting more and more difficult to act on. So if you go from an interest rate environment on guaranteed investments that might be 10 or 11 or 12%, and now you look at 5-year GICs, and we're looking interest rates of, let's say, 2%. You don't have to be a rocket scientist to understand that if you're getting a 2% yield in your portfolio, you're going to be killing the goose that lays the golden egg pretty quickly. You're not going to generate very much income out of that portfolio. So this default towards becoming more and more conservative, on the surface, that sounds like a reasonable idea. But when you look at the objective reality of low interest rates, it's a terrible idea. So the challenge is, how do you build a portfolio that is managed in such a way that deals with the risks that retirees are concerned about, while at the same time trying to drive some total return on the portfolio to fund the requirements that the retiree has for income, but not to go through the portfolio too quickly so that the person has more life than income, which would be a tragedy. That's not what we want to have happen. So let's take a look at a strategy that we call the income wedge as one way of dealing with these risks. On the one hand, low interest rates, on the other hand, dealing with capital market risks. Okay, I want you to work with me a little bit here. I've drawn a circle on this flip chart, and so this circle here is basically representative of your overall portfolio. So you're approaching retirement, you're getting very close to retirement, and you've built up these retirement assets, some of which have to supplement maybe some employer-sponsored pension plans. Maybe you're self-employed, you need to get most of your income from this source. But whatever the need or requirement is, you need to begin drawing on this portfolio. So again, we have that dilemma, low interest rates, but we all want to reduce market risk. So the first thing that I want to emphasize is that if you're 60 years of age, right, and you're retiring, keep in mind your portfolio doesn't end. Its life expectancy isn't age 60 or 61. If you live to average life expectancy, we can presume that you might be going into your mid to late 80s in terms of life expectancy. So the first thing that I always need to encourage clients to do is to think a little bit differently about their portfolio. I don't know what it is, but when people get close to retirement, it's almost like they feel like their portfolio's life expectancy declines to very short term. Now, I would argue that some of their portfolio is very short term, but a big part of the portfolio will have a 5, a 10, or 15-year time horizon. Now, that's really, really critical. And the reason for that is that we will need to still have some growth investments in the account to drive some reasonably competitive returns. The problem with growth investments, as many of you know, is that they are subject to year-by-year volatility. So over time, the portfolio might go up, but the intra-year volatility, the swings year by year, can be fairly significant. And the last place in the world you want to be taking income from is from an asset that's swinging up and down like this, right? So any assets that you park in the portfolio that are there for growth, you want to be able to have the opportunity to hopefully leave them alone for a period of years, and ideally probably at least 5 years before you start touching that part of your portfolio. What about your income though? Okay, so we've got our portfolio for growth to deliver income to us 5, 6 years out. We've got some time on our side. We don't have to worry about short-term market volatility. What do? And what we do is we put in place what's called an income wedge. And the income wedge is a very simple but elegant strategy. And what the wedge is a very, very conservative part of your portfolio. It's a part of your portfolio that won't be going up and down because of volatile markets. It could be government bonds, very short-term bonds, T-bills, GICs, that kind of thing, short-term income funds that are managed to be very low risk and don't fluctuate very much at all. And what you want to do is you want to do your homework. And so your homework is putting in here ideally 5 years of income. Okay, so if you had someone that needed $20,000 a year from their portfolio, so they need $20K a year, well, that means that in this income wedge, they're going to have $100,000 parked in these very conservative investments. And what they're going to do is they're going to use those investments, peel through them over a 5-year period to produce income. They're going to leave this part of the portfolio alone and let it grow and accumulate. And then every once in a while, when the opportunities emerge, they're going to go into their growth portfolio or balanced portfolio, and they're going to replenish the assets back to the account. So let me just, again, draw a picture for you as to what that might look like. So again, this doesn't have to be a super complicated strategy, right? You have to do your homework though. So this presumes that you've done your homework, you know what your expenses are, you know what kind of after-tax income you require, and you've taken into account other extraordinary expenses. It could be replacing the car, other travel, new roof, whatever it might be. But you've really dialed in what your portfolio needs to do for you from an income or liquidity standpoint over the next few years. Now, once you've done that, again, you know how much you need to put into this wedge. Very conservative investments. You're not going to get a really big yield, obviously, in this part of your portfolio. Where the yield's going to come from is the other part of your portfolio. Now, once the wedge is in place, what you're doing is you're just intentionally drawing down on the asset, right? So you're just pulling money out, and the portfolio is getting smaller and smaller. Now, ideally, what you'll do is from time to time, you'll take growth out of this part of your portfolio and add it to the wedge to continue the income. The ideal situation is that you have enough growth every year that you can just peel away that growth from your overall portfolio and plunk it back into this wedge. The reason you want to have 5 years worth of income, 3 to 5 years, is if markets really go through a choppy, volatile period, you don't want to have to go into this portfolio to produce income or to reallocate money back to the wedge. You want to do a timeout, not touch that portfolio, and let it reconstitute itself, allow markets to come back. So if you look at a 5-year period, that really is a good, I think, safeguard. I mean, it's very rare that capital markets don't come back within, that period or approximately that period. Even when the financial markets, the financial crisis of 2008 hit, I mean, markets did come back. Maybe it took a little bit longer than that, but certainly we saw a resurgence of capital markets. So the big thing is, in summary, decide what your income needs are going to be, build into the wedge, probably at least 5 years worth of those income needs. The rest of your portfolio should have more of a growth to balanced orientation to try to get more yield. You're not going to get a lot of yield in this part of your portfolio. You are now going to go through this portfolio, it's almost like a reverse mortgage, and start drawing down on the assets to produce income. And then from time to time, ideally it would be yearly, but it may not be the case depending on how markets do, you'll go into this portfolio and backfill into the income wedge. Well, that summarizes this particular idea. This is a really important area for those of you who are getting ready for retirement or who are retired. These wedge strategies and other strategies are things that need to be feathered into your plan so you can cope with this reality of very low interest rates, and yet you still want to maintain your lifestyle and live a reasonably good lifestyle and not have your portfolio implode because your yields are so low. So I hope you enjoyed this edition of the Take Charge of Change podcast. To get more information about financial resiliency and financial topics, visit my website at seanhumphreys.com. There's a lot of videos and podcasts around the financial area. And as well, if you're an employer and you want to run a workshop to help your staff and employees to become more financially literate, and particularly to get ready for retirement, we welcome that conversation about how we can put together customized workshops to build financial resiliency into your staff and teams. Anyway, all the best as you pursue professional and personal resilience.